Hello, I'm Noel Lim on ASEAN Speaks by Maybank Investment Banking Group. In response to rising inflation, the Monetary Authority of Singapore has double-tightened its monetary policy. Core inflation has risen to a decade high in Singapore due to rising commodity prices and reopening of the economy underscored by a tight labour market. What are the implications of this move by the central bank and Maybank's assumptions on growth, inflation and Singapore banks? Suhaimi Ilias, our Group Chief Economist, moderates the conversation.
Hi, good morning, everyone. It's Monday, 8th April. ASEAN stock markets ended mixed in a shortened trading. MSCI ASEAN Index fell 0.7%. S&P 500 also down over 2% last week as earnings season kick off. Expectation of lower first quarter profits. Inflation data was also in the spotlight. US headline inflation in March hit a fresh 40-year high of 8.5% year-on-year versus 7.9% year-on-year in February. But core inflation rate picked up more moderately to 6.5% year-on-year last month from 6.4% year-on-year in the month before. US Treasury market remains volatile. The two-year yield, which is sensitive to Fed's policy rate, fell to as low as 2.27% on Thursday from this year's peak of 2.6% on 6th of April and ended last week at 2.45%. Longer dated yields continued to rise to maintain the reversal of the yield curve inversions that occurred in late March, early April. Benchmark 10-year US Treasury yield reached a peak for this year of 2.83%. As Fed is expected to kick off its balance sheet reduction or quantitative tightening next month after QE taper ended last month. The Pan-European Stock Index ended last week about 1% higher. European stocks benefited from ECB being far less hawkish than US Fed. On Thursday, ECB meeting ended with no change in policy interest rate, but ECB confirmed the unwinding of its version of QE, the so-called Asset Purchase Program or APP that began this month, will be completed in third quarter, after which ECB will fully reinvest maturing securities purchased under APP for an extended period of time. And ECB also signaled it will start raising interest rates at some point after the end of the APP taper, but will go about the process gradually. Japan Nikkei 225 rose 0.7% as Bank of Japan asserted that Japan's economy will continue to recover despite surging commodity prices, and the central bank will maintain its massive monetary stimulus to support the still fragile post-COVID recovery. But BOJ's ultra-loose monetary policy stance, in contrast to the tightening pursued by other major central banks, has contributed to significant currency weakness. The Japanese yen hovered around its lowest level in nearly 20 years against the US dollar, finishing last week at around 125, 126 level. In China, as lockdown in Shanghai went into its third week last week, President Xi Jinping reiterated that China will continue with COVID-0 policy, arguing it is less damaging than allowing the virus to spread unconstrained across the country. And to mitigate the economic impact of lockdown, on Friday, PBOC cut reserve requirement ratio or RRR by 25 basis points for large banks and 50 basis points for smaller banks, but kept its medium-term lending facility rate at 2.85%. This is against market expectation of reductions in both RRR and interest rates. Shanghai is planning for work resumption under a closed-loop system where different parts of factories must be separated and workers live on site and are tested regularly. Meanwhile, nearly 2 months into Russia-Ukraine war, no end in sight as Russia-Ukraine talk is at the dead end amid allegations of war crime level at Russia, and as US and Europe impose further sanctions on Russia, with Russia following up with counter-sanctions. In addition, US and Europe announced additional military support to Ukraine, which Russia warns will have unpredictable consequences, overall signaling protracted and escalating conflict. Among the key macro stuff to look out for this week, IMF latest World Economic Outlook will be out tomorrow, where global economic growth is forecast to be cut from the pre-Russia-Ukraine war projection of 4.4% back in January. And on 21st April, Fed Chair Powell and ECB President Lagarde will be speaking at an IMF panel on global economy. Soon we'll have the release of China's first quarter GDP, expected at 4.4% year-on-year and 0.6% Q-on-Q, versus the growth of 4% year-on-year and 1.6% Q-on-Q last quarter. Bank Indonesia's interest rate decision is due on Tuesday. And we also have flash composites PMIs for major economies like US, Europe, UK, Japan, and Australia for the month of April out this Friday. Sessions today will be a bit Singapore-centric. We have Hak Bin, Winson, and Andy to talk about MAS and learn on Singapore banks. After that, we'll have Chee on Indonesia's macro, Jesada on Thailand, consumer finance, and Ting on regional plantation. Hak Bin, MAS tightened its monetary policy for the third time in a row last week after starting the ball rolling October last year. Can you give us a run through of how MAS policy has evolved since October up to Thursday last week?
Hey, hi, morning, Suhaimi. So the MAS made a double move on Thursday last week to fight inflation, and this came in despite the weaker first quarter growth. So the MAS steepened the slope slightly again, probably by about half a percentage, and also recentered the senior band to the prevailing level. This would probably be about plus 2% move. So this follows the two other moves that was made earlier. Bear in mind that October last year, they already started shifting to a gradual slight appreciation. And then in a rare inter-meeting move in January, they steepened the slope again. The last time the MAS tightened 3 times in a row and to such a degree was between April 2010 and April 2011, when the economy rebounded strongly in the aftermath of the global financial crisis.
Clearly inflation is the driving factor for MAS decision. MAS revised upwards its inflation forecast, but advanced estimate of first quarter GDP slowed to lower than expected, given all this base effect and impact of Russia, Ukraine war, and China lockdowns. So what's next for MAS policy?
So I think the MAS revised the inflation forecast a lot more than we expected. I mean, we were expecting a revision, but they, for like headline inflation, they moved it up by 2 percentage points. So the new headline inflation is actually now 4.5 to 5.5 from the previous 2.5 to 3.5. So that's a pretty big increase, largely probably due to the private transport costs as COE premiums surged to record highs. But they also moved up core inflation forecast now to 2.5 to 3.5. So I think they are expecting rising commodity prices, the supply chain disruptions from the war, as well as China's lockdowns are going to raise energy and food costs. And bear in mind that this is all happening on the backdrop of a very tight labor market. And in September this year as well, we're going to have increases in the qualifying minimum wage and expansion of the progressive wage model. So inflation, I think, remains first and foremost the main priority at this moment. And against this is the weaker growth backdrop. The first quarter growth was actually weaker than expected, just 3.4%. That's down from the 6.1% in the fourth quarter. Manufacturing, 6%. That's the slowest in 6 or 7 quarters. And bear in mind that the estimate actually assumes that therefore the figure in March will be 0 for industrial production. So I think we might see in the coming months some impact from the war and China's lockdowns. On the construction, very, very weak recovery, actually just only 1.8% despite a very low base. It shows that the foreign worker shortage is really acute. And we hope that this reopening will allow for the resumption of the foreign workers to flow back to restart and kickstart construction. Services growth slowed to 3.9% from the 4.4%, a bit uneven across. For the flash, they reveal different segments, but basically I think the wholesale and retail trade as well as the transport and storage sectors are a bit weaker as trade volumes ease. In fact, container throughput and sea cargo is contracting. The finance side, it seems to be fine. It's lumped together with the Infocom, finance, insurance, and professional services. That's still growing at 5.3% in the first quarter versus 6.6% in the 4Q. And then the remaining sector, accommodation, food service, real estate, admin, support, slightly faster, 3% versus 1.6%. All sectors were growing except for the accommodation sector, but this is primarily due to the fall in government demand for hotel rooms for quarantine facilities. So the big disappointment is the construction. So come October, I think with this very much higher inflation forecast, we think that the MAS is more likely to maintain the current stance because our view is that the growth is going to slow down globally as well as in Singapore. Our growth forecast is actually only at 2.8% for this year. That's below the government's 3 to 5% range. We think that the MTI may have to downgrade their growth forecast at in May when the final 1Q GDP is released, probably to 2 to 4%. Our growth outlook has been darkened, we think, by higher energy prices, manufacturing supply chain disruptions, a weaker Europe economy, and China's lockdowns. In October, we're looking for them to maintain the stance. If they do decide to make another change, and if inflation surprises an upside again, we think the most likely move will probably be a further steepening of the slope.
Thanks, Bin. Winson, what does MAS latest policy action means to Singapore rates and bond market?
Hi, morning, Suhaimi. Singapore rates and bonds are still significantly influenced by the US rates and the Fed Reserve rate hike cycle. That's why Singapore is the worst performing government bonds this year within ASEAN due to the high correlation with the US Treasury sell-off. So if US Treasury yields continue to rise, the Singapore government bonds, the SGS yields, will have to increase as well. But the MAS policy does have some impact on the Singapore rates in terms of relative performance. So a stronger appreciation bias of the Sing dollar could mean more negative FX forward points for the US dollar Sing currency pair, supporting the outperformance of Sing dollar rates market in general. So if we look at the short-term rates market, such as the Singapore overnight SORA, on average, it has been trading about 10 bit higher than the US SOFR. But because of the MAS likely keeping a neutral liquidity stance, and when the Fed Reserve starts to hike the Fed funds rate aggressively, we actually expect the spread to turn negative. That means the SORA to be lower than the US SOFR, with a negative spread, let's say, of about 25 to 50 bips. And if we look at the US rates market pricing, it is expecting the Fed funds rate to go up to about 240 or 250 by the end of the year. So when it comes to SORA, if the market pricing fully plays out, we might probably see a SORA at around like 2%. So you can see that there's a negative spread of about 50 bips. So when it comes to 10-year the 10-year SGS is going to be similar. If let's say the US 10-year yield go up to 3%, we might actually see the 10-year SGS with a negative spread about 40-50 bips, perhaps about 250 or 260 by the end of the year, if the 10-year US indeed go to 3%. But we think the risk reward for SGS has improved. Yields is quite hawkishly priced in the US, so it might actually come down between now and the end of the year.
Thanks, Winson. Andy, given mass policy tightening and Winson's view on Singapore rates in bond markets, what's your outlook on Sing dollar, especially what happened to Sing dollar in past episodes of mass successive policy tightening that include recentering upwards?
Morning, Suhaimi. Yes, indeed, the Sing-Year, the trade-weighted Sing-Year is currently up about 0.6% as of end of last week against its trading partners based on our model. And like what Harbin mentioned, based on our model as well, we're seeing that the shift in the policy band upwards to about 2% from the current prevailing level. And also the slope has been increased by 0.5 to 1.5. So the recentering is in line with what we have said just now. Indeed, the slight steepening of the slope was not in our baseline, but I think we noted that the risk of such an accompanying parameter change it could be built in. In the past, if you see the previous episodes where they actually recentered upwards and moved in April to 2010 and 2011. Typically, on average, Sing dollar typically moves around the range of about 0.5 to about 1.5% above the new midpoint. So there's still some way to move higher, up to about 1.5%. Or as I mentioned just now, we've already moved about 0.6%. So there's potential for above 1% move for Sing against its trading partners. So there's still some move. So tentatively, support is at 135.20. Dollar Sing has actually broken those levels because of the dollar moves. We are expecting Sing forecast for the second quarter to be around 135 or so, and still end the year closer to 132 and around 130 ranges on the back of some slight dollar softness and some continued Sing support. And before I end on the Sing side, I just want to say that there could be at least one more steepening in slope towards 2%. I mentioned just now we're up from 1 to 1.5, particularly because MAS flagged the tight labor market and higher domestic cost pass through. But whether this comes true in October, like what Hak Bin said, our view is I think will in turn depend on how the domestic and external cost pressures evolve in the next 2 quarters. But there is a possibility of it moving to 1.5 to 2%, of course, either in October or beyond that after that. So I mean, thanks.
And aside, Andy, any updates or thoughts on major currencies like dollar, euro, yuan, or renminbi following inflation data as well as ECB and PBOC policy decisions last week?
Yeah, valid question. So currencies have moved a bit since last week as well, but a few things. On the dollar front, I think dollar strength will continue to be there, but it can be uneven amongst the developed market majors. I think negative low yielders such as euro and yen are exceptionally vulnerable to the downside. And I think those are the things that we want to look out for. But I think if we go into a dollar, our view is dollar will be supported. If you look at it from a Bloomberg index perspective, 100 handle has broken. You might see DXY, dollar DXY continue to be go beyond 100, 101 possibly. And if it continues to be sustained higher because of some of the sentiment that we're facing now, it would be something to look out for. On the euro front, yes, so the ECB, like you mentioned, Suhaimi, earlier, I think it's on the back of what the ECB's move. It has not been as aggressive as expected by the markets. The hawkish scenario didn't materialize. So the euro actually needed a hawkish high for the euro bulls to actually be supported. But it didn't materialize. So I think like what you mentioned, with the possibility of the results of the April meeting, the weak results of that, we will put pressure on the euro. So our view, I think euro could actually see some significant pressures downside due to the strengthening of the dollar, safe dollar, but also because of the weakening euro, because of the sentiment on that front as well as the Taiwan issue that has materialized, which could continue to support on the dollar front. On the renminbi, the RRR cut is actually smaller than what market expectations. Typically, PBOC does 50 or 100 basis points RRR cut. And I think this is the first 25 basis points RRR cut in history. So PBOC has kept the quantity interest rate of the MILF rollover also unchanged last week. So I think there are concerns about the impact as well. So generally on that basis, I think on the renminbi front, easing measures could bring some near-term pressure on CNH. But with this, it could be that there could be some resilience to some extent on the CNY front. So renminbi is now at 637. We are calling for renminbi for this end of this quarter by end June to be at 635. I think we maintain that of sorts as well, and still see some bearish view on dollar CNY towards the 630 to 635 range in a 12-month view. Suhaimi.
Thanks, Andy. Let's move on to Singapore markets, specifically Singapore banks. We have Thilan here with us. Thilan, with global market volatility triggered mainly by the outbreak of war, what's your expectation on Singapore banks' first quarter trading updates to be out later this month? And will it be material to this last quarter's result? And what would be your advice to investors?
Morning, Suhaimi. Yeah, so we've seen the US banks report some very volatile results last week. Partly it's provisions for Russia, Ukraine, but also from trading income as well. There's been some major credit valuation adjustments and mark-to-market losses on some of the trading and investment securities. While for the Singapore banks, trading only makes up around 8% of income, and investment securities another 2%. Volatility here could actually have a material impact to earnings. On the operational side, we think core operations should actually be holding up. Loan growth may get delayed a little bit in first quarter, as Russia-Ukraine conflict and market volatility could have pushed some of the corporates to draw down or delay some of their drawdowns. On the other hand, the NIMs should actually be improving, but a lot of that will be back-ended because the portfolios need to still be repriced upwards. The other area that we're a little bit concerned about is on the cost side. I think on the employee costs as well as IT, we should see continued increases given the sort of tight labor market we have. Now, for investors, what we're saying is there could be some weakness in the results coming out in the first quarter, but we think this is an opportunity to buy. The operating environment in Southeast Asia is actually quite strong. There's a very clear reopening theme. So I think the overall earnings momentum for the Sing banks will be quite positive as we go through the year. So we would be buyers of these stocks in any sort of weakness. Our preferences are for DBS and UOB. So I mean.
Thanks, Thilan. Let's cross over to Indonesia macro. Jui, Indonesia's government plan to raise fuel prices and electricity tariffs in coming months. Any idea on the expected quantum of the plan increases and how much higher will inflation be as a result? And will this be a catalyst for you to change your call on Bank Indonesia's rate hikes?
Hi, morning, Suhaimi, everyone. The government is planning to raise prices of the most widely used fuel in Indonesia, which is Pertalite. It accounts for 63% of fuel consumption. And besides that, they are also planning to raise prices of the 3 kilogram LPG cylinders, which accounts for 93% of LPG consumption. And lastly, also electricity tariffs in the coming months in order to protect the state budget. This comes after the 39% hike in the unsubsidized high-grade fuel known as Pertamax, starting 1st of April. So far, there has been no indication of the magnitude and the exact timing of the fuel price hike yet. Pertalite is currently trading at around 40 to 50% below market price. And for our estimate, we assume that there's a 15 to 20% hike in Pertalite prices, and that could add around 1 to 1.5 percentage points to headline inflation, which would bring inflation above BI's target range of 2 to 4%. When we assume that the hike occurs in June after the Idul Fitri holiday, we expect headline inflation to increase to around 4.5 to 5% for this year, compared to our current forecast of 3.7%. As for Bank Indonesia, our current base case scenario is for BI to deliver 3 rate hikes totaling 75 bips this year. But in the scenario of a fuel price hike in June, we would expect to see BI tighten more aggressively by around 125 to 150 bips. If we look at past fuel price hike episodes where a hike of around 30% added around 3 percentage points to headline inflation, that prompted BI to hike interest rates immediately after the fuel price hike. And that was because bond markets saw sharp sell-offs as inflation surged. Reaction from the equity markets tended to be more mixed, while the rupiah generally came under pressure. And back to you, Suhaimi.
Clearly, the planned increase in this fuel and power costs, despite boost to state revenues from the commodity price booms, and then we're having this VAT hike to 11% from 10% effective this month. It's about sticking to this year's budget deficit target. Are there other measures on the way? Is it all about raising taxes and controlling spending?
Yeah, the government remains committed to reinstating the 3% of GDP fiscal deficit cap in 2023. And there has been other measures to raise revenue. One way is by riding on the commodity boom. So the upper limit of palm oil export levies were nearly doubled to $375 per ton. And the proceeds from this will be used to subsidize bulk cooking oil. And besides the 1 percentage point VAT rate hike, Starting the 1st of May, the VAT has been extended to crypto asset purchases, although it's only at a 0.1% rate. And earnings and capital gains from crypto transactions will be subject to a 0.1% final income tax. On the other hand, the carbon tax, which was supposed to be imposed on coal power plant emissions starting 1st of April, has been delayed by 3 months to provide some relief amid rising inflation. At the same time, the government is spending more on social assistance to help offset this rising living costs. Recently, the government has set aside 6.9 trillion rupiah for cooking oil cash assistance, and also 8.8 trillion rupiah was allocated for a wage subsidy assistance scheme to help 8.8 million low-income workers. I think overall, we would expect the fiscal deficit to come in at around 4.4% of GDP this year, compared to 4.65% in 2021, as the additional revenues from higher commodity prices and the increase in prices of fuel and electricity tariffs would help to offset higher spending on subsidies and social assistance. Back to you, Suhaimi.
Thanks, Chee. Let's move on to Thailand. Jesada, you're positive on Thailand consumer finance sector, and this is despite this environment of rising inflation, especially on the cost of essentials like food, fuel, energy. Can you explain to us why you are taking a positive stance on the sector?
The rising inflation and energy price are leading to the higher cost of living. So we expect the consumer demand to increase as they need more money to live. It's same as that we see on the banking sector, that some corporate and SME, they need more capital for the working capital loan to support the business. So for the consumer finance sector, we believe that the margin is quite high, like loan yield at 20%. So the profitability remain good, even though some customer will turn to the NPL during the high inflation time. But overall, we believe that the higher loan demand will lead to the improving the return on the equity for the consumer sector finance.
What's the stock pick for these sectors?
Our topic is ASK, Asia Samkit Leasing, on the strong earning growth and cheap valuation. And for the title loan operators, we see the clear earning visibility for Thick Law, given the high NPL coverage. And we also see the opportunity to accumulate on MTC and so on, after the stock decline about 15% year to date.
And no concern about asset quality?
We believe that, as I mentioned, we believe that the bad loan to increase during the high inflation. Yeah, but we see that in the price as the stock underperformed the market year to date. And also we expect the improving asset quality and also the loan demand to offset with the higher credit cost.
All right, thanks, Jesada. Last but not least, our regular Ting on regional plantation. Ting, plenty of moving parts on CPO price dynamics, as we know. Overall, are they supportive of your expectation of CPO price heading lower in the second half of the year from current heady levels, and hence the neutral call on the sector?
Morning, Suhaimi. So the present high CPO price has been largely due to tight global supplies of palm oil and other vegetable oils. One of the key factors has been the weakness in palm oil output in this region over the past 6 months. Besides being seasonal in nature, there is also a lack of workers in the case of Malaysia. MPOB's March stockpile that was announced last week fell unexpectedly by 3% month-on-month. To 1.47 million ton, which was below market expectation. This was a surprise and is supportive of CPO price, at least in the immediate term. But if we were to look forward to second half of this year, we expect palm oil supply in both Malaysia and Indonesia to experience strong seasonal production recovery. In the case of Malaysia, a return of the much needed foreign workers anticipated in this current quarter will also help to boost productivity and yield in the second half. In second half as well, we expect the ongoing soybean and canola spring planting in the Northern Hemisphere to yield stronger output as La Nina is expected to end by mid-year. Recall that bad weather affected last year's crop yields. With a more normalized weather forecast this year, crop yields are expected to pick up sharply. However, I would like to caution that we are only at the start of the spring planting season. Weather may still evolve, and hence close monitoring is needed. Likewise, the Russia-Ukraine conflict also needs to be monitored. A quick resolution to the Russia-Ukraine conflict before end May may allow Ukraine farmers to catch up on new sunflower planting, and this will allow the exports of sunflower seeds or oils from the last year's harvest to resume in the Black Sea region. On the other hand, a prolonged war may be disruptive on supplies and will be positive on sunflower oil prices. Our current base case assumption is still a truce to the Russia-Ukraine conflict before the end of the spring planting season for sunflower. So in brief, the current expectation is a global recovery in vegetable oil supplies in second half, led by palm oil, which will result in lower CPO prices. Hence, our neutral call on the sector is unchanged.
Thanks, Ting. That's it for today. Have a good week ahead and happy Easter.
To get more information, speak to your trading rep and check out market insights on the Maybank Trade app. Also follow ASEAN Speaks on Spotify and Apple Podcasts. Have a good trading week. I'm Noelle Lim at Maybank Investment Banking Group.